Okay, so hi everybody. Welcome to the third in our recent series of Vermeer Global Updates. We're trying to take a few of the important topics of the day on board, but just as a reminder to those people who are looking in for the first time at this update, Vermeer Global Fund is a global fund of up to 60 stocks. It's long only, fairly simple strategy. We look to invest in high quality businesses, whether they be value or growth or in the more defensive parts of the market, which perhaps been doing a little bit better of late. We take a long-term view. We've been running the money for over 5 years now, a decent track record. It's been a very choppy start to the year, probably for everybody. But we are, focusing on the long term, trying to work out what's going on with the macro economy, which is very challenging at the moment, and then seeing how that fits into our portfolio. And, just to open today's commentary with, clearly we now have another level of uncertainty that's added to an uncertain start for markets this year. We are on, maybe you might call it a war footing with the situation in Russia and Ukraine. One thing I do know about my 30 years in the stock market is that uncertainty is the thing investors and markets hate most. This has clearly added to caution in markets in recent days. But one of the things obviously we've been trying to focus on, Charlie, is interest rate policy, the central bank having got behind the curve in the US, perhaps also in Europe with the ECB, trying to normalise policy now. What do you think this situation might mean for rates going forward? It's not that long, is it, that we ago, only a few days that we thought interest rates might go up by 50 basis points in the US next month. What do we think now?
Yeah, I think that's definitely correct. The one thing that's on the Russia-Ukraine situation, I think the Fed would be in the same boat is, we don't know much more than what's being reported at the time, and we have to just react to things as they happen. And I think the Fed's going to do the same. Whether this changes the way they're going to view things will be an interesting kind of line of news to follow. As you said, the markets were nearly pricing in an almost certainty of a 50 basis point hike in 3 or 4 weeks' time in March at the next Fed meeting. Those odds have come down dramatically over the last couple of weeks, given the ongoing situation in Russia and Ukraine. But I think the point is, I think the Fed, my view is the Fed will raise rates in March. I think they have to keep the credibility that they are at least attempting to fight inflation, with their dual mandate being full employment and keeping inflation in around 2%. They definitely tick the first box, I think, on the labour market, given how tight that is. And inflation, they need to try and get under control to retain some credibility. So I think they're going to raise in March. The question over the path moving forwards is then going to be a real question. Does this give them the excuse, so to say, to press pause? The market's already pulled back on the ongoing geopolitical stuff following the initial reaction to the increased hawkishness of Fed members. So I think we've seen various takes from economists anywhere up to people who started at 4 rate hikes, their expectations in January, now up to 7 to 8 this year. I think the likelihood of them raising rates 8 times this year is pretty slim, given their their track record of where they attempt to get to versus where they actually get to on rate hiking cycles. So I think it's going to give the Fed an interesting overhang and a question mark over how their planned developments may have changed compared to only a few weeks ago.
Well, let me just interrupt you there, Charlie, and take one point up there, because I think there's two things to focus on there, isn't there? On the one hand, there's the fabled Fed put and where that might be if markets go down. And we've seen various commentators saying, the S&P would have to go down to X before the Fed put would come in, and it would slow the pace of advances. But the other thing, from a more economic standpoint that you have to focus on is just how far rates can go up without actually tipping the economy or risking tipping the economy into a recession. Because if you look back, and one thing that's really difficult with COVID, which I fully acknowledge, and I've got great sympathy for the Fed and other central banks, when you've been in a situation like COVID, which is completely unprecedented, there's no playbook really that you can refer back to as to, well, under these circumstances, we know exactly what to do because this is a typical history repeating itself economic scenario. I mean, perhaps the best example is that, COVID has been almost putting the world economy on a war footing because we've all been locked down for 2 years. And, you can look at what happened post-war in the US. and there was a consumer boom, and then the Fed put rates up, and they put them up too late, and it took the economy into recession. You think that's going to happen this time? How far do you think the Fed can go?
I think they're going to. You've already seen some economic indicators start to roll over, with consumer confidence rolling over because inflation's high. Some of the economic surprise indexes have gone from maxing out at everything coming in above expectations to really dropping off a cliff with lots of the data coming in below expectations. So I think you're already starting to see the economy roll over, but at the same time, we've had the Omicron variant going through the US specifically, finishing up towards late January. So you've got the puts and takes of data that was rolling off versus an economy that's going to be reopening post Omicron, and the likely boom for being able to travel and thing that's going to come up from there. How long or short-lived may that be? Will the trends that we were seeing going into Omicron continue? But I think you are going to see a slowdown. We haven't had the fiscal stimulus benefit that we had last year. All the attempts to get through bills, Build Back Better, or as people are calling it now, Build Back Never in the US, that hasn't managed to get through, with Manchin putting the stops, Senator Manchin putting the stops to that because of where inflation is, not wanting to spend any more money. So with the Fed trying to normalize policy at the same time, and you've got those puts and takes all going on at the same time, which gives the Fed quite a tough angle. And I think the ability for the consumer is the dominant driver of the US economy, it's the biggest proportion of GDP, and we've seen them spend and spend and spend with the stimulus. But one thing that's shown up in some of the recent results seasons is this normalization effect of a lot of the sales top line performance has been driven by pricing. And as we start to see all these things normalize, and the consumer not being in a perhaps stronger position as they were flush with cash last year, how that's kind of coming through in companies' earnings statements.
Yeah, well, I think the interesting thing about that is that obviously we are now seeing this normalization, aren't we? And we've been trying to spend a lot of time on the stocks in our portfolio. So at the same time as the central bank's normalizing, as you say, or trying to, companies now are producing results, some of which have seen a phenomenal pull forward in their profitability in the last couple of years. The stay home impacts. We saw results yesterday, didn't we, from Home Depot, which is an outstanding company that we've owned in our portfolio for quite a long period of time, sold too early, in fact, because we were concerned about impossible comps rolling forward. Saw the shares carry on motoring higher and then have come all the way back. And we're down, quite substantially yesterday on the results. And that's really the challenge here, isn't it? The companies that have seen this tremendous benefit from COVID lockdowns, pull forward of demand, where we're heading on that. And that's really difficult right now. How are you sort of thinking about that in terms of some of the stocks in our portfolio?
I think just on a headline basis, it's normalization of monetary policy, but a normalization of economies and markets as well. We've seen this huge refocus on valuations over the last kind of month or so, whereas last year it was doesn't matter what the valuation is, I'm buying the franchise, etc., etc. Whereas now people are actually really looking in more detail as to what am I actually paying for the earnings that these companies are going to put up, and the earnings growth, Home Depot specifically is a question mark, at least in the short term, as to what the growth is going to be. But I mean, in our portfolio, we've seen stocks in the sporting goods space like Nike, which have continued to execute really, really well in a tough environment. And I think there the structural growth is improved versus where it was pre-COVID. And yes, they're dealing with supply chain and logistics issues, but I think those should roll over. It's taken longer, but they should normalize to a point where it's at least more manageable from a company perspective. So, Nike's in that camp. We've got Target, which report results next week, which, I'm hoping, you look at the results from Walmart, suggest that they can continue to execute well, and that people are going to still, the low income cohort who shop at Walmart, Target are still spending on what they need to. But then on the flip side, you've got stocks that we've owned in the past, like Lululemon, which again, like Home Depot, we did sell a bit too early. We're concerned over valuation, but that's now come all the way back and has now underperformed the S&P, I think, since we sold it. And it's also, leading us to review some positions in the portfolio, but it's also throwing up options for potential new ideas within the portfolio for stuff that's now an awful lot cheaper than it was only 3 or 4 months ago.
Yeah, I think that's right. And one of the things I've noticed is that in some respects now, it feels to me like, because, if something is labeled a growth name, irrespective now of the numbers that they put up, and actually how far the valuations have come back, some stocks are still under pressure from that. And I think, in terms of the portfolio, and has been, it's been a tough start to the year, no question about that, particularly for our Japanese names, which, have a growthier bias, did really well in local currency terms last year, but, have not been what people wanted to own. I think in the same way that people didn't focus on value because they just wanted to buy franchises and they didn't care on the way up, I think people are actually starting to tip some stocks out without actually thinking about, this is a really high quality business with phenomenal cash flows, ton of cash on the balance sheet. Share buybacks can play an enormous part in, supporting share prices, keeping earnings growth up this year. I was a bit surprised, although it's probably premature, that Home Depot, with all the cash flows they've generated, didn't announce an even bigger buyback. But, you pointed out to me, well, they announced a very big buyback middle of last year, and they'll probably go again later this year. And I think that's going to be a tail of the tape going forward. So I still think, despite this obvious rotation that we've seen from highly valued growth, and clearly some stocks are still overpriced and very vulnerable. But now I think there's an opportunity to look around the whole market, not just in value, not just in growth, in all parts of the market, to find quality. And that, quality is just as good value, is just as much value as it is growth. Really high quality managed businesses, strong balance sheets, just not being in places of the market that people wanted to invest. I think there's opportunities everywhere. Clearly, markets are very uncertain. We're not expecting markets to rally strongly while we have this situation playing out, and the Federal Reserve, the uncertainty that creates as well. But I think we're starting to see some opportunities now for long-term investors to focus on all parts of the market, not just this big switch. Surely at some point, and maybe this is wishful thinking on my part, you're going to have a market where investors can focus on not just being all growth or all value, that we get to an equilibrium point and actually investors stop pick their way around the market based on high quality businesses that are now selling at the right price going forward. And that's certainly how we're thinking about things. Anyway, let's leave it there. Thanks for your time today, Charlie. Very good to catch up. Always great to get your thoughts on the Federal Reserve, which I know is something you're particularly interested in and a particularly tricky thing to follow at this time. But we'll catch up with investors again very soon. And thanks to everyone who's tuned in today. Thanks very much.